Welcome to Gambling with an Edge. And now, here are Bob and Richard.
Good afternoon. Welcome to Gambling with an Edge. I'm Bob Dancer.
And I'm Richard Munchkin.
Our guest today is tax advisor Russell Fox. Our primary discussion today is how the recently passed tax laws affect us as gamblers and as regular citizens. His website is claytontax.com and also taxabletalk.com. Russell Fox, welcome back to Gambling with an Edge.
Glad to be back.
Last time you were on, the new tax bill was in committees. You gave a best guess as to what was coming down, and you said, don't bet the farm on this. Everything's subject to change. So, tax law is now in effect. So, let's start with professional gamblers. If we file as a professional gambler, what tax changes were caused by the recent tax bill?
There are two changes. The first was a specific change for professional gamblers. In January 2011, the tax court decided the case of Mayo v. Commissioner. The tax court, in a precedential decision, ruled that, and one that the IRS acquiesced to, ruled that a professional gambler cannot have a gambling loss for tax purposes. However, he or she can have a net operating loss caused by business expenses. The new law specifically overrides the Mayo decision with a purported savings to the U.S. government of $200 million for the years 2018 to 2027. By the way, I'm not making that number up, okay? The purported savings is based on basically professional gamblers not claiming net operating losses. Based on my practice, it's vastly overstated. A much more reasonable estimate is $1 million, and frankly, that's probably high. There are not many professional gamblers who claim net operating losses. There is a second major change, and it is the deduction for qualified business income, or QBI. This deduction is allowed for sole proprietors, which is what a professional gambler is, owners of S corporations, partnerships, and some other kinds of entities. The deduction rules themselves are quite complex. Imagine Rube Goldberg doing a flowchart, and then think of the IRS improving it. The deduction is based on your taxable income. That's your income after the standard or itemized deduction, not your business income. If your taxable income is $157,500 or less, single, doubled if married, filing jointly to $315,000, you are eligible for a 20% deduction based on qualified business income. The deduction in this situation is based on the lesser of your net business income or taxable income. So let's assume John Smith is a professional gambler and earns $100,000 from his gambling. He's married to Mary Smith, who is a teacher and earns $60,000. Their taxable income before the deduction for QBI is $136,000. They will be able to take the full 20% deduction of $20,000. Their adjusted taxable income will be $116,000. That's going to equate to a tax savings of $4,400. Pretty good. There is a phase-out of this new deduction. It phases out at $207,500 single, $415,000 married filing jointly. Above the $157,500, $315,000 level, the rules for this deduction are quite complex. I could talk for 10 shows about the deduction.
You're not going to have that opportunity.
I don't want
promise.
to. But it is great material if you want to fall asleep to.
I have one question. You said 20%, but then you said $20,000. Is it a max of $20,000?
No, in the hypothetical, it was a $100,000 income. I did it deliberately to make the deduction calculation.
It's only on his income.
Yes, it's only on... The deduction is based on overall taxable income, but then it's based on the lesser of net business income, $100,000, or net taxable income, which was above that. So it'll be based on 100.
Okay.
But there is a rule that exists about this deduction above the phase-out level, and that is it's not available for individuals who earn their income based on their own performance. A professional gambler is certainly somebody who earns his income based on his own performance. Thus, above the $157,500, $315,000 level, professional gambler is going to be ineligible for this deduction. Others can get it, but the rules are really, really, really complex. The IRS says they're going to have some additional guidance out by the end of July.
What happened to do your taxes on a postcard?
Believe it or not, the Secretary of the Treasury today came out and said Form 1040 is going to come out postcard size. I'm not making that up either. The difference is all the stuff that's on Form 1040 today is probably going to be put on subsidiary schedules that are new. So that, for example, where all the lines are for income, there's going to be like a Schedule I, which will list out interest, dividends, etc.
On another postcard.
Doubtful.
You'll have a deck, like at least 52 cards.
Now, okay, so that's on the professional gambler side. Now, on the non-professional gambler, W2Gs, what kind of tax changes were caused?
Directly, none, but indirectly, there's a huge, or perhaps I should say bigly, change. Bigly. That's our president's word.
Yes.
Beginning with the 2018 tax year, there's no more exemptions on tax returns. If you look at your tax filing in the past, you'll see you get a standard deduction or itemized, and you get exemptions, one per person. So if you have dependents, you might have, children, you might have 3 or 4 total exemptions. Those are gone. There aren't any more exemptions. However, the standard deduction was greatly increased, where today it's a little over $6,000. It's been doubled to $12,000 single, $24,000 if married filing jointly. But there's a problem there for gamblers. Okay, you're allowed to take either the standard deduction or your itemized deductions. Amateur gamblers have to separate out their gambling wins and losses. Wins go as other income. Losses are an itemized deduction. So if we think about this, and let's consider, homeowners. Most homeowners in the past have itemized because of mortgage interest and property tax. They easily get above the threshold of $12,000. But under the new law, many, perhaps most, will not itemize. There's also, as part of the new law, a cap on the deduction for state and local taxes of $10,000. So let's consider a hypothetical taxpayer who's married and has $14,000 of itemized deductions. 2017, he'd itemize. In 2018, he wouldn't. Now, let's say that hypothetical taxpayer comes to Las Vegas, puts some money in a machine, wins a $2,500 jackpot. When he files his 2018 tax return, that $2,500 jackpot's going to be duly noted on his tax return, but the losses aren't going to be taken because he has his choice. He can take $16,500 of itemized deductions or the $24,000 standard deduction. He's going to take the standard deduction.
So for a non-professional gambler, unless they play a lot and have, let's say, 100,000 in W2Gs and another 85,000 in losses, unless they have a massive amount of wins and losses, then they're kind of going to get screwed.
Possibly. I mean, each person is different. Many people will still itemize anyway. For example, charitable donations are still an itemized deduction. So somebody who, for example, makes $300,000, has $10,000 in state and local taxes, mortgage interest of, say, $12,000, and makes charitable contributions each year of $5,000, that individual's still going to itemize. That individual really isn't impacted. But a lot of people will be. And I know
the
from
smaller player, right?
Absolutely.
Yeah.
And I know many players are considering or may have already moved from like $1 machines and $1 video poker to quarter. So they'll get fewer W2Gs.
Makes sense, yeah.
All right. So we've talked about how it affects professional gamblers and non-professional gamblers. Now, many of us have lives outside of gambling. Go figure. Are there any non-gambling aspects of the law that we can cover in a reasonable length of time?
Innumerable changes. Okay, the first one everyone should like. Tax rates decreased across the board. In 2017, we have tax brackets of 10%, 15%, 25, 28, 33, 35, and the top tax bracket is 39.6. In 2018, the brackets are 10, 12, 22, 24, 32, 35, and 37%. Remember, these are federal brackets. State brackets generally didn't change. As mentioned previously, the standard deduction nearly doubled and exemptions went away. For those impacted by the alternative minimum tax, that's a shadow tax system that primarily impacted individuals earning between $150,000 and $500,000 in high tax states. There's a good chance you won't be in the future. The AMT exemption was dramatically increased. Moving expenses went away except for members of the military. The peace limitation on itemized deduction vanished.
So it's better to be at war? What does that mean?
If you're in the military and you get a new assignment, you can still deduct moving expenses. If John Smith is transferred for his job from, let's say, Los Angeles to New York and has to move,
That's a far piece.
If his employer doesn't pay for it, he cannot take a deduction.
Wow.
The exemption amount for gift and estate tax is doubled. The penalty for not having health insurance under Obamacare was removed, but beginning with the 2019 tax year, not 2018. The other two big changes are there are no more miscellaneous itemized deductions. These were the deductions subject to 2% of your adjusted gross income and included things like unreimbursed employee expenses, certain legal and accounting fees, and investment expenses. Those are gone. The child tax credit was dramatically increased, and the income restriction was dramatically increased. So many, many more people will be eligible for the child tax credit. Business tax rates decreased. We now have a flat C corporation tax rate of 21%, and the AMT on corporations was eliminated. Numerous changes were made to corporate returns, and that's really beyond the scope of this. But if you have your own corporation, talk to your tax professional as soon as possible. You may need to make some changes in your business. Medical expenses now have a 7.5% limitation rather than 10%, and that was effective for 2017. And like-kind exchanges were limited to real property. So you can't do a like-kind exchange for anything but, property. Now, the scope of this can be looked at by, I picked out two very obscure changes. The treatment of individuals performing services in the Sinai Peninsula and how citrus plants are expensed were also changed.
I have a lemon tree.
Okay. If you're a citrus grower, talk to your tax professional.
So I want to get back to professional gamblers. What is the criteria for being able to claim as a professional gambler?
It's based on facts and circumstances. And there's a U.S. Supreme Court case called Commissioner versus Gretzinger that was decided in February of 1987. The court ruled that someone who gambles on a full-time basis for his livelihood is a professional gambler. Effectively, the test is based on facts and circumstances. Full-time for your livelihood doesn't mean 40 hours a week. What it means is that you are trying to earn your income as a professional gambler, and that's how you want to pay your bills. You generally do not get a choice as to whether you're a professional or not. Of course, in tax, there are always exceptions. A full-time student, for example, that's defined for tax purposes as someone who is taking at least a half load of courses for parts of 5 months or more, has a profession of student. That individual gets a choice. There are few others, unfortunately, who get choices. When someone comes to me, I have to evaluate whether or not gambling is how they're trying to earn their living. If they are trying to earn their living through gambling, probably they're a professional gambler.
But what if they also have a job but are also trying to earn as much income as possible as a gambler?
It is absolutely possible to have multiple occupations.
Okay.
Courts have ruled numerous times that, let's say that you have a day job, you're working for some business, and at night you're a consultant doing, say, web design. Nothing wrong with that. And in fact, you should be encouraged to go out on your own. And the courts have ruled there's absolutely nothing in the law that says a professional gambler can't be doing something else. There are numerous tax court cases on this subject. There's absolutely nothing in the law. However, you have to, if you want to be a professional gambler, rule one is keep good records. That should really be the rule for anything related to tax. But if you go into tax court and don't provide good, solid records that you keep on your own, you will lose. It's a guarantee.
Okay, so keep those records. and I just want to say, by the way, whenever somebody tells me that they're either a professional gambler or a winning gambler, my first question to them is, do you keep records? Because unless you have in black and white that you actually have been winning, I'm suspect of what you claim your results are.
World Series of Poker is about half finished. How does the new tax bill affect players there?
It didn't at all. Other than the changes I noted before, there's absolutely nothing changed. Caesars did make one change for Americans. You cannot use a passport alone for identification. You need a state ID or driver's license.
What? That is messed up.
Well, yeah, talk to Caesars. People outside the U.S. can still use a passport, but people who are U.S. citizens claiming that they're Americans need a state ID or a driver's license.
Wow.
Richard, why does this give you an issue?
Well, I don't have a driver's license in the same name as my passport. So, I mean, yeah, I don't want to give them my information anyway, but, I mean, you have to give them your social security number too, so that, yeah.
So you were dead in the water way before this change.
I mean, I would have maybe gone and played some satellites or something, but not under those conditions.
We've been talking federal tax so far. Can you name the states that don't allow losses to be offset against W-2Gs?
I can. Those states are Connecticut, Illinois, Indiana, Kansas, Massachusetts, Michigan, although Michigan exempts the first $300 of gambling winnings from state tax.
300.
Yes,
$300 or
dollars.
Wow. Not 300,000.
No, not 300,000. $300.
It's hardly a reason to move to Michigan.
North Carolina, Ohio, Rhode Island, West Virginia, and Wisconsin. But there's more. Hawaii has a tax called the General Excise and Use Tax that impacts professional gamblers, not amateurs. Minnesota has an alternative minimum tax that negatively impacts amateur gamblers and limits gambling losses. Mississippi only allows Mississippi gambling losses as an itemized deduction on their state tax return. So a gambler from Mississippi who comes to Las Vegas and loses money cannot take those losses. But if he goes to Biloxi, he can take those losses. Finally, New York has a limitation on itemized deductions, with a taxpayer losing 50% of itemized deductions at a New York adjusted gross income of $500,000. This limitation begins at a New York AGI of $100,000 and negatively impacts New York amateur gamblers. There are two states that have extremely positive rules on gambling losses that have state income taxes, and those are New Jersey and Pennsylvania. Those two states allow gambling losses to be netted against gambling winnings. They're the only two states that allow that.
Wow, that just seems crazy to me that all those states... So that means if I fly to Illinois and I hit a W-2G for, let's say, $10,000, does that mean I have to file an Illinois return for that $10,000 and I can't write off any losses against it?
Well, you're a professional gambler, so you're not impacted by it. It's amateur gamblers who are impacted by it. Professional gamblers in all 50 states file Schedule C and effectively can net their wins and losses.
No, but I don't know state tax, Illinois
state tax.
Oh, no,
you'll still owe Illinois state tax.
That's
but you
what
can
I'm saying.
you can take your Illinois losses against it.
Oh, you can?
If you're professional.
Oh, okay.
It's the amateur gamblers who are negatively impacted in the states that don't allow gambling losses. Professional gamblers generally are not impacted.
Okay. I thought there were some states where even professionals were not allowed to write their losses off against their wins.
There are no such states.
Okay. There you go. See, I learned something every show.
It's a state of paranoia when that's in their case.
And confusion.
All right, we are taking a brief break for commercials, and then we'll be back with Russell Fox. The South Point has more than 10,000 games, returning more than 99%. This is more than anyone else has. In June, the promotion is a $500,000 guaranteed big spin and win. Every Thursday in June, 8:15 p.m., 25 winners get to spin the wheel. Wheel amounts are $2,000, $5,000, $10,000, or $25,000. The average spin is $43.33. If everything goes to average, they're going to give out about $400,000. What this means is that the last week they're going to keep calling 5 people at a time until they exceed $500,000. There will be a lot more people called on June 28th. So you can bet I'm going to be there. You may earn up to 1,600 entries per day, where you get 1 entry per video poker dollar coin in and 4 entries for every slot dollar coin in. The promotion day is midnight to midnight, and you may earn entries after 9 p.m. on Thursdays, in addition to earning before the drawings. So there are effectively 8 days of the week where you can earn 1,600 entries a day. The Beatles would like that. Tickets must be activated between 4 p.m. and 8 p.m. on Thursday. The new semester video poker classes will begin on Tuesday, July 3rd. The first class is Jacks or Better, and the complete schedule may be found at bobdancer.com. At videopoker.com is the best place to play lots of games. If you sign up for the gold membership, $8.95 a month or $79.95 a year, this allows you to get correction on most of the game. The game of the week is Max Action Poker, where you pay 6 to 10 coins per line, and all the pay schedule categories from 3 of a kind and higher are bumped. You get a lot more valuable game the more coins you play. That is, if you play 7 coins, you get a higher EV than 6 coins. You pay 10 coins, you get a higher EV than 8 coins, etc. This is going to require learning an entirely new strategy. Since flushes and straights pay so much more than what we're used to, your intuition will be way off on how to play the hands. The highest returning versions are in the 98.8% range, which is not attractive. But the games will overhold so much because the strategy is so different that some casinos will have a Theo offered that's going to make the game worthwhile. You'll have to check this out for yourself whenever you find the game. All right, we are back with Russell Fox. Let's assume Richard and I have a handshake deal. We're both playing $25 machines, and we're there. The Royals are $100,000. The deal is, either one of us hits one of those. He gives the other guy $25,000, and the guy who hit it takes the entire tax hit. Is there anything improper about such a deal?
First, I'm not an attorney, so do not take anything I say as legal advice. See an attorney if you want a legal discussion. From a tax perspective, fundamental rule of U.S. taxation is everyone is responsible for his or her own taxes. Thus, what you propose is wrong. Suppose you go through with this, but later Richard is audited, and we'll assume, Bob, you hit the jackpot and gave Richard $25,000. The IRS in an audit will almost always conduct a bank account analysis, and they discover the $25,000 payment.
Well, wait, I would assume that if we have this deal, that when he gives it to me, he's going to 1099 me.
Well, then you're subject to tax on that.
Well, yeah, sure.
But you just said in the argument, in the question, there wouldn't be tax.
Oh, but doesn't he get to deduct the $25,000 if he 1099s me?
In the hypothetical deal, I wasn't going to 1099 you.
Oh, okay.
Yeah,
All right.
We can do a modification to 1099.
You'd have to, because what needs to be done is a 1099 issued, and you each split the income that you basically would send the other person a 1099 for $50,000, and each person pays tax based on $50,000. That's the right way of doing it. If you're going to split it 50-50, split it 75-25, and you 1099 for $25,000, whatever the split is. And in fact, the IRS has wised up a lot about this issue. On the top of Schedule C, there are a number of questions that are asked. One of them is, did you make any payments that would require you to issue Form 1099? And, of course, this would. And right underneath it is the question, if yes, are you going to issue all 1099s? And a great way to get yourself audited is to say, yes, I did payments that needed 1099s, but no, I'm not going to issue them.
Yeah, well,
that doesn't seem very smart.
No, but trust me, it's done. But seriously, what you're proposing in this hypothetical just is wrong and is a clear violation of tax law.
All right. And it's done all the time.
But of course it is.
What if you just decided to gift the other person $25,000?
Well, you can do that. Of course, you'd need to file a gift tax return. It would be
what's the limit on gift tax?
It's now $15,000. Now, it wouldn't probably be it's technically called a taxable gift. There probably wouldn't be any tax owed because of the lifetime gift tax, estate tax exclusion, which is now $11 million.
Jeez.
I'm unlikely to give Richard more than $11 million.
At least this year.
Well, that's for all gifts for your life, and also goes and works hand in hand with the estate tax exclusion.
I think I'm safe there too. Yeah. Okay, now, World Series of Poker or other poker tournament. Let's look at, say, satellites. Satellites are a small number of players play, and the top 1 or 2 or 3 players get paid, frequently in terms of entries into the main event or some other $10,000 event. Players often make deals at the final table. They're down to 5 people, 3 of them get to move on, so they make some kind of a deal. Now, a player who plays these and would be generally interested in such a deal, what tax form should he have with him to protect himself for when these deals are made?
Well, let's talk 2 different kinds of deals.
Okay.
Let's talk first the satellites. Because a satellite is basically, if you enter a satellite, it's a parlay bet. First part is you're entering the satellite, and for example, at the Real, you'll be paid in satellite chips, which are buy-in chips to something else. So you haven't won anything. Those buy-in chips say no cash value on them. I know, I had one of them and used it to enter in another tournament. So they're not directly taxable unless you exchange them for cash. So let's say I win a satellite and get 3 $500 buy-in chips, and I sell them to you for $1,500. Now I have income because I've gained cash. I have $1,500 of income less my cost to buy into the satellite. And whatever that difference is, that's income to me. But otherwise, satellites are different than almost any other form of poker because you're not winning something directly. You're winning another buy-in. You have to win that other event to have something that's taxable.
If you win a satellite where the payoff is $10,000, will they give you smaller chips, or are they going to give you one $10,000 buy-in chip?
It depends. Most of the satellites at the World Series give you $500 chips because that's all they made. So if you win, for example, if you play like they'll have mega satellites or super satellites as another name for the same thing on like July 2nd and 3rd to enter into the main event, which is a $10,000 buy-in. And if you win one of those, you'll get 20 $500 buy-in chips. Okay. However, they have some must-play satellites. For example, there currently is going on as we record this a $25,000 buy-in tournament for a pot limit Omaha. And people who played a satellite into that were given an entry into that event. So they were given basically a piece of paper saying, you're entering this tournament for $25,000. So they have
And was
both.
that transferable? Could
No.
you sell it?
No.
You could not?
I don't believe you could sell it.
Wow.
And there's a reason for that, and that is the Rio doesn't want to issue lots of paper. If it's transferable, suddenly it has cash value. They don't want things with cash value because then they have to issue W2Gs. And they want to decrease their costs or keep their costs low.
Well, but how is that different than a $500?
They're not $500. They're not worth $500. Remember, they say no cash value. They're only usable as buy-ins to something else.
Yeah.
So with that, they're basically still, let's say I play a super satellite, win an entry into the main event. Well, I've won a buy-in. I still haven't won anything with cash. I have to win or make some money in the main event to actually earn something. And that's the difference.
Right, but in the case of the 25,000 pot limit Omaha, they could just give you 50 of those chips, right? And instead of the piece of paper, and then it would be transferable.
Correct. I could transfer, but then it still maintains at least the illusion of it being buy-in chips. The buy-in chips themselves prominently state on them no cash value.
Yeah.
Now, well, let's go on the other kind of satellite, which is where I think you're really more aiming, which is we're at a final table of a tournament.
Yes.
We'll assume first place is 40,000, second place is 30, third is 20. Three of us are there, and we agree to chop it evenly, 30,000 apiece. Many casinos will actually issue paperwork based on whatever we want. For example, the Venetian Hotel will absolutely do that. So if the prize pool was a stated 40, 30, 20, and we agree on 30, 30, 30, the Venetian will issue 3 W2Gs for $30,000.
And actually pay the people the amount.
And pay the people exactly what it is.
Because I remember in backgammon tournaments, there were certainly instances where people agreed on chops, and then the guy got the money, and, suddenly he wasn't to be found.
Okay. The other casinos locally that I believe will basically go with whatever the players want are the Wynn Encore, Binion's, Aria, and the Golden Nugget. Planet Hollywood is owned by Caesars. Last year, I think they were issuing paperwork based on redistributed prize pool, in other words, deals, but I'm not sure this year, so I'm basically remain uncertain. Unfortunately, the WSOP at the Rio, quite famously, will not get involved in deals. That means the onus is on every player. Actual tax filings aren't due until year end, so 1099s aren't going to be issued typically until year end. So what should you do if you're at the WSOP and you're heads up and want to make a deal? You need 2 different IRS forms. Forms W-9 and W-8, B as in Baker, E as in Edward, N as in Nancy. You can get both forms on the IRS website. Just do a search in their search box for those, and you'll find them very quickly. W-9 is used for Americans. W-8-BEN is used for non-Americans. So let's say that I'm playing at the World Series and I was last weekend, and I get heads up with Bob, and the prize pool...
I was doing something else last weekend, just in case you wanted to know.
Okay. Well, I didn't get heads up. I finished 62nd in an event. But Bob is... first prize is $100,000, and second prize is $70,000. So we agree to chop it. So whoever gets the $100,000 is going to pay the other person $15,000. Get the tax paperwork first. Have the person fill out a W-9 form before you pay them. And if you pay in cash and chips, get a receipt. Use any piece of paper. The person who receives the money just signs. Received from Russell Fox, $15,000, signed and dated. That'll work. Now, also, non-Americans, you need to be extremely careful. There is withholding requirements that may exist. Do yourself a favor. There's an article on my tax blog, taxabletalk.com, about taxes in the World Series of Poker. Look it up. There's a section about non-Americans. Read it. Don't do a deal without reading it, because you may be required to withhold 30%. When you issue paperwork, you become the casino, and are responsible for withholding where appropriate. And if you don't, the IRS can come after you for that 30%. You also need trust. Richard just mentioned backgammon tournaments. Well, 2 or 3 years ago, the final 5 players of one of the WSOP's daily deep stack tournaments agreed to a deal. Play ended, players got paid, but the winner, who needed to distribute some of his winnings to others, got a guard escort and drove off into the morning light. The WSOP management said, "Not our problem." You may be wondering about Form 5754. This is an IRS form designed for a situation where winner does not get all the winnings. The Rio refuses to honor this form. I think they're in violation of IRS rules, but until the IRS comes after them, there's nothing we can do.
Wow. Is there somewhere where you can complain that they're not following the rules? That the IRS may, if they get enough complaints, be spurred into action?
Yes, you can always complain to the IRS. There's a way of doing that, but it'll probably be ignored because I started complaining about it in like 08 or 09, and it's only been 10 years. But I should point out, IRS takes a long time to do things. In certain areas of tax, we're still operating on temporary regulations issued in 1983.
Wow.
Now, I'm a video poker player. In some casinos, after January 1st, they come up and the first W-2G I get in the year, they give me a W-9 to fill out as well. Is that the same W-9 form? It presumably saying I certified that this is my Social Security number.
Yes.
Is that all the W-9 is for? Or
yeah, the W-9 just says that my name is Russell Fox, my address is whatever, my Social Security number is whatever.
So do they need to do that every year? They need a new one?
They don't technically need it every year if the address hasn't changed, but most businesses like to get that, especially because people are mobile and the IRS. There's an issue when you issue a 1099 and information is wrong. So let's say I issue one of you a 1099, but you've moved, or you've changed your name, or I have the Social Security number that's wrong. I'll receive in the mail from the IRS 1 to 2 years later, because the IRS is not efficient, what is called a B notice. And this B notice says if I issue another 1099 to one of you, I need to get a picture of your ID, a picture of your social, and I need to get a W-9 signed by you verifying the address and all the information. So most casinos just basically say, let's just not get into that problem. Let's just have the person self-certify every year. And it's a good idea.
Recently, on your website, taxabletalk.com, you had a cute article about the Cincinnati Reds giving away bobblehead dolls to the customers who showed up on a particular day of the week. And somehow this bobblehead case got to tax court. Now, this doesn't affect the listeners of the show other than it kind of tickles my fancy. What was that all about?
Well, it actually got to the Ohio Supreme Court and was just argued within the last couple of weeks. And it's a sales tax issue. So the Reds buy bobbleheads to give away as a promotional item. The Reds need all the promotional items they can get because this year they're, well, dreadful. So
they're the New York Knicks of Major League Baseball.
Yes, there are some teams that
are Cleveland Browns. What other examples can we use?
So they gave these bobbleheads away, but the Ohio Department of Taxation said, where's the sales tax? Because the idea being, when something is sold, somebody ought to be paying sales tax on it. So the question is, unless it's an exempt item.
But it's not being sold. It's being given away.
Well,
obviously that was their argument, right?
Well, that actually wasn't their argument. Because if they're giving it away, then they need to pay sales tax when they buy it from somebody, or use tax. In this case, it would be use tax. They bought it from an out-of-state seller. So let's say I'm selling the Reds bobbleheads, which they're giving away. They're out of state. I don't have to collect sales tax. But the Reds have to pay what is called use tax, the equivalent of sales tax, when you buy something from an out-of-state purchaser, unless they in turn are reselling it. The Reds made the argument they're reselling them as part of the ticket. So they, for example, let's say a box seat costs $30. The box seat itself is $28, and $2 of it is for the bobblehead. That's basically the Reds' argument. And the in the lower courts ruled, no, it's a promotional item. You're throwing it in gratis as a way of getting people in the door. So the Ohio Supreme Court is going to have to decide whether bobbleheads are truly a promotional item or promotional but part of the ticket price.
Yeah, you can see that we're focusing on the important issues of the day.
Well, okay, we've had guests talking about Bitcoins and other forms of cryptocurrency.
Oh, yeah, this is actually important because the last time you were here, you were saying that I think they need to be treated something like a foreign bank account or something, or what actually needs to be declared if you have Bitcoin?
Well, the Bitcoin itself, if you sell it in any way, and a sale means you sell it for US dollars, you exchange one cryptocurrency for another. So Bitcoin for Ripple, which is another cryptocurrency. You spend
it's also a really excellent wine.
Okay.
Or was in the late 60s and
only
70s.
If you were 16 and couldn't get Thunderbird.
It came in a really cool bottle. Oh.
I'd have to ask my brother. He's the wine expert of my family. But also, if you go in a store and spend it, that is a sale. And so if you sell cryptocurrency, you have to report it as a capital gain or loss. Every single transaction must be noted on your tax return. It's treated identically like stocks and bonds. So, for example, if your broker, you have stock in, say, IBM, and you sell it, that gets reported on your tax return, be noted on 1099. Here, though, these aren't really noted on 1099s. They still have to be reported. Additionally, if you have cryptocurrency held in a non-U.S. exchange, Binance, which is based, I believe, in Japan, you need to report your account with Binance as a foreign financial account. Now, that's debatable, but we think that's the best practice. There's no harm in over-reporting. The penalties are ridiculous if you don't report.
So a company like Coinbase, I don't know if they're U.S.-based or not. If that's true, shouldn't they be responsible for issuing forms for every purchase and sale?
Well, Coinbase is U.S.-based. They're based out of San Francisco. And Coinbase itself, remember, these aren't stocks. They're not bonds. Cryptocurrency is property. And while there are regulations requiring 1099s to be issued for stocks and bonds, there's no such regulation for cryptocurrency today. Doesn't mean you don't have to report it.
They're not reporting anything.
They are for certain people. First, they're issuing a form 1099-K for certain individuals who have, I believe, over $20,000 in transactions. And it just shows the dollar amount of transactions, not the detail. Second, the IRS sued Coinbase. Or actually, they did a summons to Coinbase. Coinbase sued the IRS to stop it, and Coinbase lost. So Coinbase has now disgorged information about certain transactions for prior tax years. And you can bet the IRS is going to be going after all other exchanges that are based in the U.S. to get the same information.
So all these people who have been buying and selling Bitcoins thinking that it's all anonymous and the government can't track what you're doing, a lot of these people could end up with a giant tax problem coming down the road.
Or may have one today. We've worked with several individuals who have major cryptocurrency issues. I've spoken to other tax professionals who have also worked on this. The record keeping for a lot of people leaves something to be desired. And my best advice is if you are an active cryptocurrency investor, 1, keep good records. They'll sound very familiar. And 2, get them together now, and you may need to amend some prior returns. Very famously, all income is taxable unless Congress exempts it. Congress has not exempted cryptocurrency from taxation. So if you have gains in cryptocurrency, you owe tax on it.
This kind of reminds me of when the IRS came in to the dealers in Vegas in, I believe it was 1981, and basically said, because no dealers were not declaring their tips prior to that. There was no way for anybody to know what anybody was making. And in 1981, they came in and said, starting January 1st, 1982, you have to declare 100% of what you're making in tips. If you do, you'll have amnesty for all the years prior. But, if you don't, we're going to come after you. And I had a lot of friends who were under declaring what they were making, 82 going forward. And the IRS came after them and they got hit with huge tax bills because they were able to show that other dealers in the same place were declaring more than what they were declaring by a lot. And yeah, a lot of people were faced with huge tax bills. So,
well, you had an interesting way out of this by working only a month or two.
Yeah, I called up the IRS and I said, what if I only work a month, but I declare 100% of what I make? Do I have amnesty for all the years prior? And they said yes. So yeah, I worked for a month, over-declared what I made, and then quit the job. And a couple of years later, I did get contacted by the IRS, and they said, we're auditing you. And I said, wait a minute, I thought I had amnesty. And they said, you had to declare 100% of what you earned, and you only declared $4,000. And I said, but I only worked a month. And they went, oh, okay, never mind. So I was relieved that they honored the deal, because I never would take that for granted that they're going to honor that whatever deal they made.
Well, right now the IRS is locally, I think it's just about over, has been doing an investigation of people working at the clubs here in town. Shockingly, the IRS thinks that some of the cash tips for people working in clubs have not been noted on the tax returns.
You mean like when it rains money?
Yes, shockingly. It's just shocking. Now, a lot of these people, though, are covered by what are called tip compliance agreements. And that is where a casino, hotel, and the IRS come to agreement that if you're paid X, we'll assume the tips are Y. And if you don't opt out of that agreement, and the casino will just add a flat rate of tips to your wages. Well, the IRS is still auditing people on this issue, not basically to change their taxes, but to find out, basically, are these tip compliance agreements accurate today for people working in clubs? And the IRS thinks they're not, and they're right, of course. But if you follow a tip compliance agreement and you haven't opted out, and your tips are correctly noted on the W-2, you're not going to have your taxes changed. IRS still has the right to audit you, mind you, but it's basically an investigatory audit so that they can change the tip compliance agreements.
Okay, I just want to, because I know a lot of our listeners are interested in Bitcoin. And so if they are buying and selling Bitcoin, keep good records, but so they just need to note, like, the cost of what they bought, how much it cost, the date, and same with the sales?
Yes, but it gets very complex because there are things that have happened to things like Bitcoin. There's what you might consider splits. There's now Bitcoin, Bitcoin Cash, Bitcoin Gold, and these people just got for holding Bitcoin. And so there are issues. How do you treat this? Okay, do you have basis? I bought one Bitcoin for $5,000. Now I own one Bitcoin Cash, and one Bitcoin Gold. Do I split that $5,000 amongst all of these? Do I leave the $5,000 in Bitcoin Cash and Bitcoin, and zero in Bitcoin Cash and Bitcoin Gold? There are no set answers here, and people who have complex crypto situations should talk to their tax professional. IRS has not issued any guidance on cryptocurrency since 2014. Both the AICPA and NAEA, the two major professional societies in tax, have asked the IRS to issue additional guidance, and I'm sure they will sometime before I quit taxes in, 10 years or 15 years.
Every year for the first couple weeks of April, you stop your taxable talk post because you're kind of busy. So you've prepared beforehand something called Bozo Tax Tips, which are published on, a daily basis in April. And you've prepared them beforehand. And some of them are quite humorous.
All taken from real people, real cases of
Unfortunately,
what people did.
Yes. If it's stupid, somebody will do it.
So there's...
You mean like eating Tide Pods?
There's a picture of this one gal who posts pictures on social media about all the money she has, and she says she's refusing to pay taxes on it, and she's not gonna serve 1 day in prison ever. But for some reason, she's now in Club Fed.
21 years. Twice she got that sentence.
Wow.
Yeah, she put a post.
Does she get it consecutively?
No, it's one sentence. She published a post on Facebook saying, "I am the queen of tax fraud. Government, come and get me. You will never do it." And posted a picture of herself holding packets of either $5,000 or $10,000 in cash. I can't remember.
Well, the picture showed blue straps. Now, blue straps are like smaller bills. The ones for 5 and 10,000 aren't blue.
Okay. Well, she had many pictures. Okay. Shockingly, the government did come after her.
No sense of humor, those guys.
No. Especially, I have very little sense of humor about identity theft, and that's what she was doing. She got arrested, tried, found guilty of a whole bunch of things, was sentenced to 21 years. The sentence was thrown out, and she got resentenced to the exact same 21 years with enhancements upward. So sometimes winning is a loss. And so she is serving 21 years, making, pennies an hour now, working at Club Fed instead of showing pictures on social media. Helpful hint to anyone who wants to commit tax crime or any other crime: don't publicize it. It's not a wise idea.
All right. The last thing we want to talk about is today there's some kind of a sales tax Supreme Court decision. Do you know anything about that?
I have glanced at it. It came out this morning. It's a case called Wayfair, which is a internet company. Under a decision that came out in the early 1990s called Quill, the U.S. Supreme Court ruled that in order for a company to owe sales tax, they must have a physical presence in a state. So let's say I sell widgets and I'm based in Nevada, but I sell to South Dakota. I don't have to collect sales tax in South Dakota. Okay? South Dakota passed a law saying everyone who sells stuff on the internet has to collect sales tax in South Dakota, with a couple exceptions. And there was a certain dollar amount. I want to say it's $100,000. So mom and pop sellers were exempt, but, Amazon, for example, would not be. And there was also a specific number of transactions. The South Dakota courts ruled that the law was unconstitutional based on Quill and was appealed to the U.S. Supreme Court. The U.S. Supreme Court ruled this morning that the South Dakota law was constitutional. And the things they noted in the decision were that, first, South Dakota has a reasonable sales tax system. For example, California has something like 700 tax districts. So to collect sales tax in California and somebody's in Tulare County, well, are they in the Visalia sales tax district or the Tulare sales tax district? That's complex, whereas South Dakota signed on to something called the Streamlined Sales Tax Initiative, and basically South Dakota sales taxes are real simple to calculate. Second, the Supreme Court stated that the South Dakota law exempted people who really shouldn't have to deal with this, the very small sellers. So South Dakota's law meant the burden, and it wasn't a burden to interstate commerce, and so it was valid. Now, I have not fully read the decision. The decision came out at 7 a.m. this morning. I just glanced at it. I'm going to have a post on it on my tax blog probably tomorrow. I'm going to read through the decision later today. So people who are interested in this, look at taxabletalk.com. There'll be a post about it.
The last time you were on the air, you suggested using the email address rcfox@claytontax.com. If our listeners want to get in touch with you, is that still the best way?
It is by far the best way.
Thank you very much, Russell Fox. This has been very educational and interesting, especially the bobbleheads. Thank you, Richard. Go out and hit a royal flush, everybody. Good day.